good afternoon, everyone, and welcome to this session. I'm Courtney Fingar, and I'm a contributing editor for Real Asset Media. I look after the FDI side of the business, so I actually love any discussion about global capital flows. Now, there is a distinction, of course, between real estate and real asset and broader capital flows and foreign direct investment, but they are all intrinsically linked, and a lot of the very same trends impact capital flows of all kinds. And we're going to delve into what some of those trends are, get a bit of a read of the market. We're going to hear how bad is the news, but what are the prospects? Are there any green shoots we can look at? Where are the opportunities? At heart, where is the money? Where is it coming from? Where is it flowing to? Because that's actually what it's all about here. And we have an excellent panel of experts who are going to talk us through this topic. First, we're going to have a presentation looking at the latest research on capital flows from Tom Leahy, who's the head of EMEA Real Estate Research at MSCI. Now, he's going to tell us a bit about global deal flow and the impact on pricing and values, which of course is extremely important. And then based on how depressing or not his figures are, we will see whether we all need to go immediately have a drink or whether we'll stick around and discuss it further. Now, after that, we will be joined on the panel by Dilip Awatani, who's a director of the real estate, who's a director and real estate portfolio manager for key accounts at Universal Investment. Give a wave. And Stephen Miles, head of strategic capital partnerships for Europe at Schroders Capital. Welcome to both of you. So I'll hand over now and change seats with Tom while he presents what his research tells us.
Hello. Thank you, Courtney. I'd advise a drink anyway, no matter the good or the bad news. Well, that's my Irish side coming out of me. Okay, so I actually did a similar Richard was kind enough to ask me to do a similar presentation this time last year at EXPO. And at the end of the presentation, I think he got people in the audience to put their hands up and asked who was optimistic about the next 12 months and who was pessimistic. There was one unwise optimist. Everyone else was pessimistic, and maybe if you think about deal flow, you'd be correct, I think. So just as a bit of background, real estate has had 13 years of summer. You know, my favorite films, 500 Days of Summer. We've had 13 years post GFC where we had very, very low interest rates, low bond yields, and that pushed a lot of capital that might have been in fixed income into real estate. So this is this big gap here between where bond yields are, the risk-free rate, 10-year government bonds, and where property transaction yields are. Now, obviously, it balloons around a little bit, but the story's one of a substantial gap pushing capital into real estate. Obviously, the world has changed quite a lot in the last 18 months. Interest rates have rocketed as central banks have tried to fight inflation. So the yield gap, that rationale for investing in real estate, or some of the rationale for investing in real estate, has shifted quite a lot. So that's led to a lot of uncertainty in real estate transaction prices. And that uncertainty initially is manifesting itself into very low deal volumes. So this is global property transaction volumes everywhere. The MSCI transactions database captures a deal. It goes into this chart, so it represents billions and billions of dollars of real estate. And you can see down to I think I'm maybe obscuring it, the last quarter's data looks very, very slow indeed. So a very slow transaction market. And how is that impacting country by country? You can see there are some differences, and this is looking at the year-over-year changes in deal volumes. I've got the top 10 markets globally on here. It's a relatively uniform picture, actually, with the exception of Japan, which I've highlighted in orange there, where Japanese investment is holding up relatively well. And I think some of that's to do with the fact that the Bank of Japan have taken a completely different approach to their monetary policy, or they've shifted it slightly, but they have not seen anywhere near the aggressive tightening that we've seen elsewhere in the world. And that aggressive tightening has created the uncertainty in pricing, and we're seeing it manifest itself here in the slowdown in deal volumes. So what does that do to property performance? Well, in the last 4 quarters, total returns globally have been negative. So this is the MSCI Global Quarterly Property Index, and looking at the income return, capital growth, and total return. So total returns have been negative, and that's been driven by falls in capital values, and a lot of that is to do with the outward shift in transaction in yields. We're also seeing a reaction in terms of the transaction prices. So that was valuation data. We've also got pricing data from deals that are happening in the market. That tells largely a similar story, which is the market peaked, not only in terms of volumes, but in terms of pricing around the middle of last year, and it's starting to slow. So we're seeing falls in prices. So a good question would be whether we expect to see that continue, I guess. Well, in this kind of market where we've got property prices falling, that raises the impact of what impact does that have on market liquidity? And we've tried to quantify that here by looking at loss aversion and how that impacts property market liquidity. Investors of all stripes, and this is a well-known phenomenon in the academic literature, are highly averse to taking a loss on a purchase, whether that's an equity investment or whether that's a real estate investment, and there's plenty of evidence to support that. So there seems to be a direct link between this tendency towards loss aversion and market liquidity. So on the horizontal axis, we've got the percentage of properties in these markets which may be worth less than they were acquired for. So we've done a mark-to-market exercise using our transaction price data. On the vertical axis, we've charted that against the market's liquidity score as against its maximum ever recorded, and RCA, MSCI produce a liquidity score for 155 markets around the world. So essentially, in the markets where we see fewer properties underwater, or potentially underwater, liquidity is holding up better than those, somewhere like London, for example, where up to 50% of properties could be worth less than they were originally acquired for, and liquidity is well below its long-run average. And you see that in the global office market as a good example of this. So this is office properties trading all around the world, and it's the number of properties, so it's not the volume, so it's not a dollar amount, it's the number of properties. That's about as low as it's ever been. So very, very slow period for office and investment, and that's clearly linked to that loss aversion trend with the repricing that's going on, but also some of the more structural headwinds that are being faced by the office market at the moment. And we've got another way of quantifying that illiquidity in the market, and that's through something called our price expectations gap, which is a snappy title for a piece of analysis that we've run using our transactions database. And what we're trying to do is quantify really the bid-ask spread in the market, and what's the gap that needs to be bridged between where buyers want to acquire an asset and where sellers are willing to trade, that needs to be bridged to bring liquidity back to its long-run average. So in San Francisco, we're saying -40 at the moment, so that implies a very, very substantial spread between where buyers want to acquire assets and where sellers are willing to trade. But that's true of all these global office markets, but to varying degrees of severity. So a very substantial differentiation in those markets. But there are some sectors where actually market liquidity and market activity is holding up a little better. And rather than just looking at those year-over-year transaction figures, I've done a comparison here between the first half of this year. This is the first half of the year average between 2015 and 2019. So that avoids all the disruption that was caused by COVID, with markets slowing because of the restrictions, then reopening, and we saw a slew of deals. So it removes some of that kind of that funny period and looks at a sort of a slightly longer term average. So you can see actually there are some parts of the market, and primarily industrial, where transaction volumes are actually above where they were in that pre-COVID period. So there's clearly still appetite and still deals being done in some segments of the market, particularly industrial. Why is that? Well, again, if we look at this is another of my favorite kind of scatter plots. This looks at the changing capital values year over year for Europe. This is European countries and sector combinations. Changing capital values and market rental value growth up to the end of June for the 12 months. So you can see I've ringed these industrial markets where you've seen quite a significant correction in capital values, but actually rents are still growing quite strongly. Real rental growth as well, not just inflationary growth, real rental growth in some of these markets. So as the slide says, the value correction plus rental growth seems to equal an opportunity because industrial got very, very expensive by the end of 2021. So the fact that there's been quite a significant revaluation is pulling some players back into the market because they can get a more attractive entry point than they could a couple of years ago. And who is buying industrial property? So I've got the global on the left-hand side and Europe on the right-hand side. So it's a lot of the major players. GIC obviously very active through a couple of large entity level deals in North America in the first half of the year. But Blackstone also very active in Europe, acquiring properties in the UK and also in the Nordic region as well. Some distressed assets come into the market in Sweden, and they were able to acquire those at quite a significant discount, I believe. But there's some fairly big global blue chip investors still acquiring industrial property. And then last couple of slides, what are the chances of rebound in Q4? I think, judging by some of the conversations I've had here, and looking at our numbers, the market still seems to be pretty slow. I'm not hearing a lot of people say we've got a number of deals in the pipeline that we're hoping to finish by the end of the year. I think there's still that uncertainty over pricing, I guess the trajectory for interest rates seems to be flattening out a little bit, but I think there's still concerns over where pricing should be in the market. So there's no real pickup so far in deal flow over the summer, which is what this chart is showing. But what do we need to see that accelerate? I think price discovery is clearly an issue at the moment, but we are seeing that start to happen in real time, and this is a good example of price discovery happening in real time. This is a property that was brought to market, I think is in April, and was under offer for £70 million. This is a London office. That deal was terminated because the buyer pulled out, I believe. The property then comes back to the market and has just traded at a 20% discount to the price at which it was under offer back in April. So that's the discount that's being demanded by buyers to get these deals over the line, and so that clearly helps with price discovery. I think you can see that in a bit more detail here. And notably, this is a London office that was bought by Whitbread, who own Premier Inn, and they're going to turn this building into a hotel. So that feeds in also to that trend where we're seeing reduction in demand for office property and conversion as a potential solution for some of these properties. And finally, I think one last question. Where might the recovery happen first? I think it's reasonable to assume that those markets that have corrected fastest and furthest are more likely to see the rebound happen sooner. So this is the year-over-year change in capital values across all these countries. You can see the UK down at the bottom there. And that might suggest the UK is closer to the trough than some of these other markets. Somewhere like the Nordics, where I was in Stockholm a few weeks ago, where I think there's a sense that there's still further to go. Somewhere like UK industrial property, we're already seeing transaction prices start to bottom out. So I think it's reasonable to assume that those markets that are further into the correction will be able to rebound soonest. That's it from me, at least for the time being.
Thank you.
Thank you, Courtney. I'll hand over to you.
Thanks very much, Tom. Just a couple quick follow-ups. You highlighted San Francisco. What's going on there, and how related is it to, there's a lot in the news about the tech companies and trying to make their employees back to work, but there's some resistance. What's going on there, and is there a link between the activity of the tech companies? There's also been mass layoffs.
Yeah. No, my mic back. Yes, I think a lot of it is linked to that. So in a lot of those US West Coast cities, you've seen a real hollowing out of the downtown areas. Mm-hmm. And that's linked to the fact that people haven't really returned to the office in as great a number in the US as they have in most of continental Europe and the UK. And so you get into this vicious cycle where people haven't returned to the office, so you get businesses closing down. Mm-hmm. There's social issues as well with drug addiction and things like that in a lot of these West Coast cities. And so that seems to be having a real impact on market sentiment. I think Hines have just handed back the keys on a development in San Francisco, for example. I was talking to some clients of ours who were over from Washington, D.C. earlier. They're saying the same thing is happening over there. I was in Portland in Oregon earlier in the year on a sort of holiday, and you're seeing the same thing in the downtown areas there where there's a lot of businesses boarded up. So I think sentiment towards offices in the US, especially West Coast offices, I think has really fallen away very markedly. And that's that implied discount.
It's a little bit rosier of a situation in Europe with the offices, correct?
Yeah, yes, to some extent. We haven't seen those. We don't have the same social problems. I think people are in the office a little more. People in Europe tend to live in small apartments, smaller properties. They tend to live closer to the office. They're happier to use mass transit, which people aren't using in the US. People live in bigger houses. They live further away from the office. They have to get in their cars. So I think the picture in Europe is definitely more nuanced than it is in America.
There are a lot of these national and local factors, as we've just discussed, but to what extent is the global geopolitical uncertainty and tension creating some of your scarier graphs?
I mean, geopolitics is tricky. I think you have to look at how the geopolitical events impact the factors that real estate investors think about. So how do they impact what's happening with interest rates, cost of capital, economic growth, things like that. So Russia's invasion of Ukraine obviously caused a spike in European energy costs, which led to higher inflation, and you saw that impact Germany in particular, for example. So sentiment in the German real estate market fell away very sharply last year, and I think some of that was linked to what was going on between Russia and Ukraine. But those are factors that real estate investors have to be aware of and try and manage, but obviously they have no control over.
Thank you. And this may be a good opportunity to turn to Dilip and Philip. How is this uncertainty and some of the factors that we just discussed impacting investor appetite? I'll start with Dilip first.
I think there's a lot of questions in that one question, I think, so I'll start with
tackle it bit by bit.
Let's go bit by bit. So I think, first of all, let's go back to geopolitics. I think geopolitics is always very particular to a country or to a particular area in a region. And I think, it impacts certain things like Taiwan, for example, and the tension with China. It does impact other markets too, where there is a lot of, there could be liquidity if there was foreign investment, but there's none because people are uncertain about what's going to happen next. So I think that's where you go to that. I think if you look at what investors think, we've actually launched a survey on real estate that is actually just published last night. From our investors talking about where they want to go and where they want to allocate capital and what they want to look at. I think, first of all, one key message, I think, mainly because we're here in EXPO Real in Germany, Germany less so than it was before. So I think we're looking at a small decrease in Germany. We're hearing more about people wanting to go to Asia, to North America, different markets and totally different environments. You need to stop me when because I'm going to talk a lot about this. But I think, at the end of the day, I think the idea is that, every market is so different. Even Asia, it's a lot of different markets. North America is just one market. It's easier to do. Yeah. It's a lot easier to do. But I think, and then you look at different cities. Yeah, I agree with the office part that Tom was talking about, But it's also a fact that even if you have, vacancy in office, it's actually about occupancy. Not about vacancy. It's about people actually are going to the office or not, because you could have, in San Francisco, we have buildings where they're 85% leased, but they're only 20% occupied. So what does that mean? That means that the local shops and restaurants are all suffering. And there's no vigilance or anything on the streets. You get much more problematic social environments in the streets suddenly, and that's what happened in the West Coast in the U.S. and all the markets. Seattle, right. I think it was in Seattle even in the pandemic, just after the pandemic, but it went down all the way now to LA even. So you see a lot of problems there too with the city centers really, because no one's going there. The commute is longer. And especially if you look at San Francisco, it's very particular because the tech sector has very low unemployment. So even if Elon Musk tells everyone to come back to the office, they're going to say, sorry, we're just going to go to another company.
Too bad, yeah.
Yeah, too bad. We're going to go to another company, which lets us work remote because no one wants to go back to the office. So it's just a big commute. It's a bit of a hassle. You lose time, and some companies are thinking about productivity too, and they're thinking it's maybe productive just to leave them in the office than at home office. So I think that's where we are. But sorry, just giving you a couple of answers to a couple of questions, but handing over to Stephen now.
Well, I mean, you covered a lot of things. I mean, the main point is around geopolitics and how does that impact sentiment. I mean, I think that, it does influence where the capital is going. I think that, people become more cautious around, and look, I mean, I cover the European markets. I would suggest that when we saw what happened in Ukraine, the sentiment towards the markets, the closest proximity to where we had, to Ukraine, sentiment fell dramatically. I think people get nervous. So I think geopolitics has a play. We also have a business in Asia, and we have been working there for a number of years. We're looking at new strategies. It wouldn't surprise anybody to say that currently a broad Asia strategy that includes China is again something that needs a lot more narrative around the long-term and benefits of investing in that country. So it does impact sentiment, and sentiment impacts flows.
Yeah. So we've talked about some of the distinctions in geographies, but I wonder about sectors, and are there, outliers, and what are the distinctions that we need to make between performance of sectors? Tom, how do you see that? I mean, how would you break out or create these distinctions?
I mean, some that came out in the presentation, hopefully, which was the stark difference between. I picked on office and industrial property, particularly because there's two structural stories at work, one positive and one negative. And you're seeing the correction in industrial has been particularly sharp, but that's because industrial prices got so keen, and industrial values are so keen at the end of 2021 that actually there was really nowhere else they could go, nowhere else for those prices to go other than once interest rates started to move out, yields had to follow. But actually, I think the liquidity in the industrial market has meant it was easier for valuers to revalue the industrial assets, partly because the deals were still happening, so there was transaction evidence coming through, whereas we're not really seeing that for offices because the market is so slow, there's very little transaction evidence. And as you can see on that example I showed you with the London office, when properties are coming to the market, sometimes there's a significant discount being demanded for them to trade. And so that's a good example of some of the dichotomies. I mean, if you think about residential investment across Europe, that's slowed very sharply. But there's, I think, structural reasons why players want to remain in the residential space. It's just that the rapid rise in interest rates has made what was the lowest yielding asset class in Europe suddenly look slightly problematic, especially when you're trying to write new deals. But I think the structural trends that were driving capital into, beds and sheds prior to the sort of inflationary interest rate shock we've had remain in place. It's just the market is having to readjust to this new monetary policy cycle that we're in now.
Yeah. Dilip, what are investors keen on? What have they gone off of?
Well, I think they're keen on almost every sector. The problem is they're slowing down. I think the issue is that when you look at globally around, we're invested in every single market around the globe, I think, with some exceptions. But I think you look at it, first of all, when you look at the European investor base we have, for example, they're much more interested in going into Asia and to other markets where they think there's more GDP growth. Growth has been very, very slow across the Western Hemisphere. In the US, it's still picking up and it's still there, but it's in Europe, it's been very, very flat for a long time. Real growth has been very flat and very low. Asia has growth. Has what is interesting also in Asia, what Tom picked up is it has fairly low inflation and low interest rates. The only exception probably is India, but that's a very particular market in itself because India is a self-sufficient market. It's massive, it's growing, and it has inflation but also high interest rates, but it still grows incredibly fast. And maybe the basis is very low, we're starting from, but still it's a fantastic growth and still the most populous country and I think one of the biggest economies now in the world, even the fourth or fifth, I think. So I think you look at that, but if you look at China, for example, China has 0% inflation. Zero. Has a 2.7% interest rate, but it's very low and doesn't move that much. It's a very, very stable market environment to operate in. The only people that most people are scared to invest in China because they don't understand and you also have a legislative problem, which is also difficult for most international investors to understand. So I think you look at that, there's much more factors which come into these things. So it does require, as Stephen said, a lot more analysis into what you want to do in China. If you look at the other markets, I can, from the slides, you can resonate the fact, residential, there's a pent-up demand in residential. It's always been there, and especially in the bigger cities, where, London, massive pent-up demand, residential. Problem is no one can afford it because interest rates moved up quite well.
Yeah.
So I think that's where we're stuck. That's why the demand has gone down a bit on the residential side. But beds and sheds is still the main play. You saw industrial logistics is the one which is actually moving the needle everywhere still. But that's just also a transition still from the retail environment to the online shopping environment, online delivery environment. So I think it's still a bit of that going on. But I think also that will peak at some point in time. And I think office is the most complicated one because office, in my view, is the one which is also changing the most. The way we actually use an office is very different than maybe 5 years ago or 3 years ago, even pre-COVID. We use it very differently nowadays. We're thinking about offices much more as an environment rather than as a desk and a meeting room and maybe some facilities. We think about it much more like a working environment where you have breakout places, you have a place where you can mingle and socialize, a bit more relaxed, a bit more comfortable atmosphere, maybe some other things associated to it. I think that makes it very different, and I think that's why there's another problem. Another issue with office, which I think people keep forgetting, I think recently also, is ESG. Yeah. Massive thing, if you look at London, for example, a lot of the, you cannot rent out offices with at least a B rating in the environmental rating if you can't and most of the offices in London don't even match to D or E, so you're looking at massive refurbishment opportunities there too, but at those values and at the cost you're paying right now with inflation and with interest rates, it's going to be quite expensive to do, so and you won't recover it from the rents you're getting. So
thank you. Stephen, sector-wise, what are you keen on? What are you not so keen on?
Might just pick up on, I don't think people are forgetting ESG in offices. I think it's gone now from the theory to how much is it going to cost.
Yeah.
And I think that that's where people are getting to now, and the playbook's starting to evolve. Look, geographically as well, just pick up on this as well very quickly, but I think, investors are looking for growth, but I still see a lot of demand for the deep, transparent core markets. I don't see that abating dramatically. But it's about where and when and what sectors, and I think that, as Tom mentioned earlier, there's some push and pull factors in terms of where we're seeing the money going into in sector-wise. I think that investors have for a long time been heavily invested in what has been the most traded asset class, which is offices. And I think when they look across, the music has stopped suddenly, and they look across their portfolio, and it's like, wow, my weighting is quite high compared to where I would like it to be if I now look forward and look at where I want my risk. And I think there's a correction there, and it's come at a time when there is a rethink for corporates about the utility value of an office to the business. And I think that's an equation that is still playing out, and we don't know what those numbers are yet. And then you add into that the macro tailwinds around housing shortage in almost every part of the space, aging populations, and the way we shop now has dramatically boosted the way we use and the need for last mile and sort of different types of logistical use. So I think all those things are coming together at a time when we've also been, so there's some of those things are fundamental, and they've come at a time when the financial markets are also going through some challenges.
Yeah. So let's talk a bit about where the money is coming from, who the investors are, and then what they're looking for. And Tom, you touched a little bit, I think, on the sources. So where is the money coming from these days, and what's it looking for?
So, the money that is being spent, because clearly the transaction volumes have slowed markedly. I mean, a lot of it's coming from institutional, some of the deeper pocketed institutional players. So you saw Blackstone on that list of top buyers of industrial property. GIC have obviously been on there as a major sovereign wealth fund. You've seen ADIA come back into the European market for the first time in a while this year, so that's another sovereign wealth fund out of the Gulf. So we're seeing flows of capital from those players with deep pockets, and some of those players who are looking for opportunistic style investment, like Blackstone, for example, acquiring those properties in Sweden I mentioned, but also some of those players are also able to take advantage of some of the mispricing you're seeing in the public markets with some take-private deals that we've seen earlier this year involving GIC. A little bit of private capital as well coming in, and you do see that at times of dislocation. We saw that in central London post the Brexit vote in 2016, where suddenly you saw some deals involving high net worth individuals from Hong Kong, for example, who might have had a historical link to London, taking advantage of the mispricing at a time of market stress. And we've seen a little bit of that. And then one final source of capital we've also seen come into the global market, more so this year than before, is from Japan. And as I mentioned earlier, the Japanese economy, they're sort of they're desperate. The Bank of Japan has spent 30 plus years trying to encourage inflation, so now they've finally got some. They're not going to kill it off by increasing interest rates, so you've seen Japanese capital which can borrow very cheaply at home and spend abroad. So there was a large deal involving a Japanese investor buying 50% of a Manhattan office tower earlier this year that put a bit of a floor under Manhattan office pricing, which had seemingly shown quite a lot of weakness. So Japan is one source of capital which is and these investors have come into the market at a time when others have stepped away.
And you spoke a bit about private capital. Where can we add to that and speak in a little bit more depth about family offices? So are they growing in their appetite and their significance? I
mean, we don't see a massive flow of capital in our numbers from family offices. It tends to be kind of around the edges and maybe the odd trophy asset here or there. But I guess we're not always seeing what they're doing in terms, if they've got an investment manager acting on behalf of a family office, we'd look at that as an investment manager. But certainly our numbers don't necessarily show a big slew of family office money coming into the market so far this year. But that's not to say it's not happening, it's just kind of how we track the market.
And if we're thinking about US investors, are they still as interested as ever in Europe and US private equity groups? Where's their appetite?
I think where there's opportunities, certainly. So Blackstone and Brookfield both have bought in the Nordics, which is a market that's experiencing quite a lot of distress already in the first half of the year, linked to various other factors. So Brookfield came in and bought 50% of a portfolio from SBB, an education kind of focused assets across all 4 Nordic countries. So I think where there's opportunity, you're probably likely to see some of those more opportunistic North American type private equity players come in the same way that we saw in Southern Europe from sort of 2012-13 onwards, when post-Eurozone debt crisis, there was a flow of capital into those distressed markets from North America.
Thank you. And Stephen, what's the role or significance of global investment managers in bringing in the capital? And
look, I think that accessing interesting opportunities right now requires a ground-up approach, a bottom-up approach. I think it's your route to market is through good operating businesses that can deliver the returns, and I think the global managers just bring some institutional rigor to the underwriting and investment process. So I think the role of the investment manager is there to give confidence and as I say, that the rigor around What you really need, though, is the bottom up. That's real estate is still very local, and there's a lot of different factors influencing individual markets. The way Paris has reacted compared to London, it's different. You need that footprint and that presence. So it's that top down and bottom up combination that I think the investment managers are able to bring to the universe of capital that wants to get deployed in the sector. I mean, I think just picking up on where the money's coming from, I think there's a lot of institutional capital that is challenged right now. Some of it is overweight real estate because of the impact on values in the other assets that they're holding. I think that where we do see capital, it's from the sovereign and some of the semi-sovereign pension funds, insurance, and we are seeing quite a bit of private wealth coming through. But it's all quite demanding. It all wants returns that have shifted up, given where interest rates are, without necessarily subscribing to wanting much more risk. So we have that kind of playing through as well. So it's an interesting environment in where that capital is coming from right now.
Is there anything you would add to that, Zilip?
I mean, I think we talked about pricing and about the issues. I think, I've seen now 3 cycles in real estate, really 3 big cycles, and I think there's always a lag between price adjustment, which happens between 6 months and 2 years, depending where you are, what the factors are behind it, and everything else. But there's not many people are gonna look at buying assets in secondary cities without having any knowledge about it. You need a global investment manager to actually guide you through the process, understanding, is there a demand for this? How would they actually manage the asset? Because an investor for a sovereign wealth fund or or even a high net worth individual is not going to run the asset. They want the investment manager to run the asset. So I think they want to have the skills and knowledge and also the capabilities of that local manager. Now, they vary differently depending on which city you're in. If it's a secondary city, if it's a primary city. But we've seen a lot of investors now recently also. I mean, we've seen high net worth individuals buying properties in London for £200 million, by the centre. That you saw that one too, I think, and there's a couple other aspects too. We see plenty of investors looking at other assets. I think, yes, sovereign wealth is coming in. Japan is coming in a little bit, but I hate this word, green shoots. I've heard it so often. I hate this word so much. But there's some green shoots, but I don't think they're really permanent streams of capital. They're not. And I think the transaction volume reflects that right now. I think you're not going to see a lot more changing over the next while. And I think what we've seen right now is the end of a real estate cycle. It's been the longest one I've seen ever. 12 years or something like that. It's been the longest I've ever seen. And I think. And it really was fueled by low interest rates and by other things. Now, inflation has really killed off every sort of aspect. But you've got some tenant adjusted rents now, which are helping investors. But not all the rental contracts are inflation adjusted. And if they are, they have a cap sometimes, which it doesn't really reflect the actual growth of inflation we have right now. So, yes, there will be a long period of price adjustment still.
Can I add something as well, just regarding that sort of in terms of where you invest and who you invest with? I think the other thing that we're seeing is that some of the sectors that are more in favour are more operational assets, and I think that really does require a much more hands-on approach. I think that the days of an investor filling their book with 25-year leases. That kind of doesn't exist anymore, and I think that you need to be invested through someone that understands the evolution of that owner and occupier relationship. It's shifted. It's much more hands-on. It's much more dynamic than it used to be, I think.
Is that an improvement? I mean,
I think it is. I mean, I think that it also, as you get closer to your tenant, you're also able to understand their business and what's driving their business, and I think that allows you to be a better manager of that asset when events occur. You know, you've got a much more engaged dialogue. So no, I think that is for those managers that are able to do that. That's good news, I think, because I think it, you know, that, as I say, the time of 25-year leases is probably not coming back anytime soon.
Thank you. Well, let's end on your good news then about this new exciting closer relationship. Thank you very much for sharing your insights, for your presentation, and for your analysis and comments. Thank you very much to our audience. Let's give a round of applause. Thank you for those tuning in to the broadcast virtually. And we just want to flag what's coming up next. Richard will take back over and lead us through European debt finance and investment. Then we'll be talking, as ever, about ESG strategies and looking in a bit more depth at impact investment and how to implement these strategies. And then the drinks that Tom made us need will happen at 6 o'clock here at the bar. And this is where we're bringing together the themes of impact investment and foreign direct investment. So please join us for that.